Hey everyone, welcome to the live stream. Thanks for joining us. I wanted to jump on and talk about this because this is something that I've gotten quite a bit over the last few weeks, because a lot of people have been asking me about, why do I keep saying we're headed into a recession and all that type of stuff. And I look at a bunch of data and statistics and indicators and all that stuff. First of all of them are pretty much negative. I should say all, but almost the big ones I look at are all negative. So when you look at them in isolation, it doesn't really mean anything, but you look at them all stacked up, yeah, it means a lot, okay? And I'll give you an example of two things that I look at, and logically, this is gonna make a lot of sense to you, like, oh shit, like this makes sense, regardless of like if you're a finance person or not. It's gonna be like, wow, like this could get really bad really fast, okay? And what I mean by that is that back in 2020, when COVID hit back in March, right? Before that, we were already high credit card debt, more than 2008. Okay, a lot of people don't realize that. We were pretty much not in a great situation, but we had a lot of headwinds, tailwinds, everything was looking good. Then COVID hit, right? And credit card debt spiked. It was the highest it had ever been. And that makes sense, right? The economy shut down, which means people couldn't go to work and get a paycheck. So before they did the whole PPP thing and sent out, checks to people and all that type of stuff, people were like, oh shit. And they didn't have any paychecks. So they had to, use their credit card. So we saw credit card debt just spike to the highest it ever been. And then once all these other things started happening, the economy opened up, it drastically reduced. It was right off the cliff. Everything was great. Enter 2022. Inflation, all this stuff. Credit card debt is higher in this country right now, total credit card debt. Now, and this excludes all these new things like buy now, pay later, okay? It excludes that. Credit card debt right now is at a higher spot than COVID. Think about that. The economy literally shut down. Like you could not go to work. You couldn't do anything and make any money. We're saying we're in a worse situation than that. Like, wow. Like I even saw a CEO from a big company announce that their whole buy now, pay later stuff, people are actually using that to buy groceries. Like that's why the credit card is going up. It's not discretionary spending. It's day-to-day needs like food. Like that's just going up. Credit card. It's like that is a telltale sign that the economy sucks. Okay, like again, think about that. We're in a worse situation than when the economy literally shut down. When people we're told you cannot go to work. Nothing was functioning. No restaurants, no nothing. We have more credit card debt than then. I view that as being in a worse situation than that. That is incredible. Okay. Now, so that's one thing I've been looking at. But the big one that I looked at back, because I've been saying this for months, like it's coming. We're already in a recession. It's going to get worse. Okay. Is the inverted yield curve. And typically when we look at yields and bonds, let's just say you look at a 5-year loan, like if you're looking at like a 5-year loan for yourself versus like a 30-year loan, the 5-year interest rate is going to be lower than the 30-year. Okay, that's just the way it works. That's how most of the time yields happen. That's the way bonds work, mortgages work, all that type of stuff. Every once in a while, we have what's called an inverted yield curve, where the short term is higher than the long term. So let's just say the short term might be 5% and the 30-year might be at 2%. So it inverts. Statistically, it has like a 95% probability of when that happens that there's a recession coming, right? So again, these are the things I look at. You just look at, I just gave you 2 of them. Like you start adding up all these things, it doesn't look pretty. So what does this mean, obviously, to all of you that follow us, that are subscribed to us? Again, if you're not, make sure you subscribe, because we're starting doing more live chats, but we also do weekly updates and videos and all that type of stuff. So make sure you subscribe to the channel, hit the notification button, so that way you get updated when we put these things out. But what does all this mean to you? What should you do? Should you panic? No, don't panic. I always say the end of the world only happens once. If it's now, your money's going to be worthless anyway. So whatever, right? So prepare yourself that, hey, everything's going to go down. Stock market's going to go down. Home value, all this stuff is going to go down. It's going to go back up. And I think it's going to go up actually pretty drastically once it goes back down. Okay. That's just outlook going out to the future. But prepare yourself. So like when it comes to like the retirement stuff, keep dollar cost averaging into it. Statistically, it works. Right now, if you're an investor, yeah, you're trying to time everything, get out of the market here, put it in here, all this type of stuff. But if you're just trying to look, I just want a good long-term game plan with your retirement, keep dollar cost averaging. Now, if you want to do anything, maybe make it a little bit more conservative versus like just being gun-ho in the stocks. But if you don't want to try to time the market, just keep going, okay? Things like real estate, right? Like if you are buying a house, first of all, you already know affordability just went off the cliff with the interest rates rising. But maybe you sit back and say, look, I shouldn't buy stuff right now, like a house, because housing values are going to go down, especially if you have a short-term outlook, like you're only be living there for a few years or something like that. Like if it's your forever home and you just have to buy it, then yeah, have a strategy of going into it. Maybe use some type of, instead of like a 30-year fixed P&I type of loan, maybe you do something different so it's more affordable in the short run. There's a number of different things you can do in strategies. I'm not going to talk about that today. Actually, we just came out. If you guys didn't see it, we did a live chat and video. I actually just launched it live on YouTube about an hour ago with our partner. We do a quarterly update for the real estate market. So if you didn't see that and you want more information on like creative ways to buy like in this situation and still have to be cheap, make sure you watch that video because we went through a lot on that. Okay. Overall, just be more frugal. I mean, just try not to buy stuff right now. Try to just hoard as much cash as you can. I know it's hard because of inflation, but just try to tighten up a lot, just because the more cash you have, the more prepared you're going to be. And then if you're more prepared and everything's okay and assets and stocks and all that stuff go down, you're gonna have more cash. Now you go and invest and you're going through the roof. So thanks for jumping onto the live chat. Again, if you guys haven't subscribed, subscribe, hit the notification button, like this video, tell your friends. Talk to you soon.